Most married couples choose married filing jointly without a second thought. Why? Because the reason is the standard deduction is higher and the tax brackets are wider. It is the default for a reason. But what if I told you that default could cost you thousands in student loan payments, tie you to your spouse's secret tax errors, or even disqualify you from valuable deductions? Today, we're breaking down the 5 traps of filing a joint return that your software might not tell you about. This presentation is for educational purposes only, and it is not a tax or legal advice. Let's dive into the 5 traps of filing jointly. The biggest trap isn't a math problem. It is a legal one. When you sign a joint return, you are agreeing to joint and several liability. This means the IRS views you and your spouse as a single unit. If your spouse underreports their side business income or takes a shady deduction, the IRS can and will come after you for the 100% of the debt, interest, and penalties. Even if you divorce later, that joint return keeps you on the hook. You are essentially signing a blank check for your spouse's tax honesty. Trap number 2 affects anyone on an income-driven repayment plan for student loans. If you file jointly, the Department of Education usually looks at your combined adjusted gross income to set your monthly payment. For example, if you earn $50,000 and your spouse earns $70,000, filing jointly could double or triple your monthly student loan bill. In many cases, the tax savings of filing jointly are completely wiped out by the massive increase in loan payments. This is a classic case where filing separately might save you more cash flow every month. Trap number 3 is in relation to unreimbursed medical expenses. You can only deduct expenses that exceed 7.5% of your adjusted gross income. If you file jointly and have a combined income of $150,000, for example, you have to spend over $11,250 just to start deducting. But if one spouse had high medical bills and lower individual income, say $50,000, filing separately drops the threshold to just $3,750. By filing jointly, you might be earning your way out of a huge deduction. Trap number 4, garnish refunds, the offset trap. We touched on this in our injured spouse video, but it's worth repeating. If your spouse owes federal debt, like back taxes, student loans, or child support, the IRS can take the entire joint refund to pay it off. Even if 90% of the income was yours, your refund is at risk the moment you hit submit on a joint return. While you can try to get it back later using Form 8379, it's often cleaner to file separately and keep your money in your own pocket from the start. I have to be fair. There is a separate penalty. These are what you're going to lose if you file merit filing separately. Filing separately to avoid these traps comes with a cost. The IRS penalizes merit filing separately by disqualifying you from the Earned Income Credit, the Child and Dependent Care Credit, the Student Loan Interest Deduction, and if one spouse itemizes, the other must itemize too, even if their deductions are zero. So what's the solution? How do you know which way to go? Well, don't guess. Run the numbers both ways. Look on what your tax owing if you're married filing jointly and what is your tax owing if you're married filing separately. A professional tax analysis doesn't look at the bottom line of your tax return. It looks at your student loans, your legal risk, and your long-term financial goals. If you're worried about joint liability or your student loan payments are skyrocketing, let's talk. We can help you navigate the fine print of the tax code. If you need a clarification on your specific circumstances, book a clarity call with us. Email us at hello@usautax.com. If this was helpful, give it a thumbs up and subscribe. Thank you for joining me. See you in the next one.